Hello students, welcome back to my channel GK's Education. I hope your study is going well. Please do not forget to like and subscribe my channel. So we know partnership accounts is going on. Up to the previous video, our chapter admission of partner is complete. So today we are going to do the third chapter of this part of partnership account, that is the retirement or death of a partner. So it may happen that while working, any partner, because of health reasons or because of some other reasons, may retire or may do not want to, you can say, work further. So he may get a retirement, or it may also happen that because of the act of God, a death of a partner may happen. So in both the cases, whether the partner is retiring or whether there is a death of a partner, in both the cases the partnership is reconstituted. That means there is a reconstitution of partnership is again rearranged, all the things are changed, and then the new partnership firm is come into being, we can say. So let us study it from the material. On retirement or death of a partner, the firm is reconstituted. That means the firm is again arranged. In that case, the existing partnership deed comes to an end and a new partnership deed is framed where the remaining partners continue to do their business on changed terms. That means the previous partnership deed comes to an end because it was having that retiring or deceased partner, and new partnership is framed where the remaining partners continue to do their business on the changed terms. That means at this time, at this moment, they can change the terms if they want. No much difference is there on the change or retirement of a partner in the accounting treatment of books. That means on the death or the retirement of the partner, not much change is there. In both the cases, the accounting treatment is same in the books. In both the cases, we have to calculate the sum due to the retiring or deceased partners. That means in both the cases, whether there is a retirement of a partner or whether there is a death of a partner, in both the cases we have to calculate the sum due to the partners. um, uh, After making necessary adjustments in respect of goodwill, revaluation of assets and liabilities, and transfer of accumulated profits and losses. That means in both the cases we have to make the adjustments for goodwill, revaluation of assets and liabilities, and transfer of accumulated, we have to transfer the accumulated profits and losses to the partner's capital account. Also, we may have to calculate the new profit sharing ratio among the remaining partners and their gaining ratio. That means we have to calculate the new profit sharing ratio and their gaining ratio. Earlier, when the admission of partner is there, in that case, the previous partners have to, we can say, sacrifice their part of profit. So in that cases, we used to calculate the sacrifice ratio. But here, when a partner is going out, and so the continuing partner will get some gain, so here we calculate the gaining ratio. So as in the case of admission, the various accounting calculations are done in the case of death or retirement. So here we have to calculate the various things, as in the case of admission we did. So what these things are, let us find out. Finding the new profit sharing ratio and the gaining ratio. So the first thing we have to do is, on the case of death or retirement, is finding the new profit sharing ratio of the continuing partners and their gaining ratio. Number 2 is treatment of goodwill. Number 3, revaluation of assets and liabilities. Number 4, adjustment of unrecorded assets and liabilities. Number 5, distribution of accumulated profits and losses. Number 6, calculation of the share of profit or loss up to the date of retirement or death. That means only up to the date of the retirement or up to the date of the death of partner, we have to calculate the share of profit of that on that outgoing or deceased partner. Adjustments of capital accounts if required, so that will be done also, and then settlement of amounts due to the retiring or deceased partner. So all these 8 points we have to follow whenever there is a question of retirement or death of a partner. So let us find out. The first topic is calculation of new profit sharing ratio. So new profit sharing ratio is the ratio in which the remaining partners will share the future profits after the retirement or death of a partner. It means it is that ratio where the remaining or the continuing partner will share the future profits, will share the coming profits after the retirement or death of a partner. The new share of each remaining partner will consist of his own share in the firm plus the share acquired from the retiring or the deceased partner. So that also comes in question. New share of the partner will what it will contain or what it will consist of. It will consist of his own share in the firm. That means his own share plus the share acquired from retiring or deceased partner. Means we will add the part of the share which he will acquire from the outgoing partner. Now what happens? Normally the continuing partners acquire the share of a retiring or deceased partner in the old profit sharing ratio. So that we have to keep in mind. Usually what happens is they they acquire the share of the retiring partner in the old profit sharing ratio, and there is no need to calculate the new profit sharing ratio among them. So first case is when they acquire the share in the old profit sharing ratio. So in that case only what we will do, like if there are three partners sharing the ratio 2:2:1, the the third one is retiring, who is having the ratio who is having the share 1/5. So in that case that one will omit, only 2:2 will exist among the continuing partners. So if by in the ratio 2:2 they will acquire the share. It happens in one case. Now in second case, in the absence of any information for the profit sharing ratio in which the remaining partners acquire the share of a deceased or retiring partner, it is assumed that they will acquire it in the old profit sharing ratio. It is in that case, in the case when there is any absence of information, means when there is not anything mentioned in the question, in that case it is assumed that they will acquire it in the old profit sharing ratio and will share the future profits in their old ratio also. That means but there is if no change is mentioned in the future ratio, in that case it is assumed that they will share the future profits in the old ratio. We will do one example to clear these things. A, B and C are the partners in the firm sharing the profits in the ratio 3:2:1. If B retires, A, B and C having the ratio 3:2:1, and what happens if B retires, the new ratio between A and C will be 3:1 unless they decide otherwise. Means if B retires, the middle one person retires. So in that case the future ratio, we will cross this thing, only both of them they will have their same ratio existing in the future unless they decide otherwise or unless it is mentioned. So that is what I was saying at this point. Then number 2, the continuing partners may acquire the share of the deceased or the retired partner in the proportion other than their old ratio. So it may happen that it is decided among them that they will acquire the share of the outgoing partner in the proportion other than the old ratio. It may happen. In that case there is a need to calculate the new profit sharing ratio among them. So when they decide that they will not acquire the share in the old profit sharing ratio, then there is a need, then we have to calculate the new profit sharing ratio among them. So for example, N, S and T are the partners sharing the profits and losses in the ratio 5:3:2. S retires from the firm and his share was acquired by T in the ratio 2:1. Now calculate the profit sharing ratio, new profit sharing ratio of the partners. So let us check it out. The solution. Yes, the new share of continuing partners. The new shares, as we did in the explanation, is old share plus share acquired from the outgoing partner. Now, old ratio of partners is, as per the question, is 5:3:2. They are NS and T. NST. So their old ratio is 5:3:2. Now, gain ratio. We have to calculate the gain ratio. It is given. The gain ratio is 2:1. That means they are gaining, they are taking it in the ratio 2:1. Now share acquired by N, 2/3 of 3/10. How 10? 5 plus 3 8 plus 2 10. 2/3 means this 2 plus 1 3. 2/3 he is getting of the previous ratio of outgoing partner, that is 3/10. So it will come out to be 2/10. And the share acquired by T, 1/3 of what? The share of outgoing partner 3/10, that is 1/3 into 3/10, it is 1/10. So share N acquired 2/10 share and T acquired 1/10 share. Now the new share is old share plus acquired share. Old share is 5. For N it is 5/10. So 5/10 plus 2/10, that is 7/10. And for S, for T, sorry, it is 2/10. 2/10 how? The previous year 2/10 plus the acquired share. That means it comes out to be 3/10, or their new ratio will be 7:3. So this is how the things are done. In the coming video we will do the other problems of the various topics. Like here we did the calculation of new profit sharing ratio, and then we will do the gaining ratio in the coming video in detail. I hope you are getting the points very clearly. Be with me to complete your whole syllabus, and do not forget to like and subscribe my channel. Thank you.